Quick disclaimer for this video. I hope you can learn something about my process for finding mutual funds and learning about what all the options are that are out there. This is not financial advice. Make sure to do your own research when it comes to investing your own money. It's very personal and there can be lots of great wins, but there can also be a lot of losses in this. So do your due diligence, make your decisions on your own, and always contact a professional if you need help. There's financial services that can help you. They can give you one-on-one guidance, and of course, on the tax side as well. And talks with a tax professional when it comes to claiming your gains or your losses at the end of the year. Here's going to be my simple ways for how I go about investing and finding which mutual funds or which index funds I actually wanted to invest in. I want to do this as a quick video as well, just because in our last one we talked about how I started investing, and that was back when I was like 15, very young, just starting to earn a little bit of money and getting into everything, learning about it. It can be very daunting. There's a lot of information out there. There's a lot of different accounts that you can sign up for. But the one nice thing to remember, and I think as Warren Buffett has made very popular, is that it should be very simple. You should understand the investments that you have, and you shouldn't make anything that you don't. If you feel uneasy about something, usually the gut feeling is something that you should trust and something that you can lean into, and it just means that there's more education that needs to happen before you're actually ready to dive in. So I've got a couple screens pulled up here, and the first one is just going to be like, how do we go from nothing to something? And as I talked about in the last one, there's going to be a couple different investment opportunities. Everybody's typically heard of stock accounts, stock funds. When a company goes public, they break their company into a bunch of different shares, and then it lets everyday people buy a certain amount of those. And that's going to be stock options. And so when you have stocks, you are owning a specific company, just one and done, nothing else. And a lot of people wanted to diversify. And so rather than having to buy a lot of those individually, you can actually just go ahead and buy a mutual fund, which is going to be a lot of companies all rolled up into one. Now, the only thing you have to be careful of, especially when you're getting into it initially, is that just because there's a lot of companies in something doesn't mean it's properly diversified. And diversification can mean many things. It can be across a sector, across a region, across multiple sectors, or even globally as well. And there's going to be pros and cons with both. The more diversified across the entire world or across all the sectors is going to be, it's going to spread out those gains and those losses. And so it'll be a lot more steady across time, but you may not have as high of peaks. Right now, the technology sector is just crushing it, and it has been for the last few years. So if you were more diversified, you wouldn't have seen as good of returns as somebody who had all their money in the top 10 tech companies in the US. But on the flip side, if those were to go down or not perform well over the next few years, if you're properly diversified, you won't feel the pain nearly as much either. And so there's pros and cons to weigh, and you have to look at your situation, how much time you have, when you're going to need this money, and that will help you determine how risky you're willing to be and how. Okay, so this first page, all I did was Google top index funds. As I mentioned, stocks and mutual funds. An index fund is just going to be an unmanaged account. So these big companies, they're just going to take some type of an algorithm to determine it. And for the S&P 500, it's just going to take the biggest 500 companies in the US, which is a great way to start. There's a lot of entrepreneurship in the US. The companies typically do very well. And the nice part is it allows companies to move in and out of it as well. So if a company's doing really well and they're not in the S&P 500, well, every year they do an evaluation and it can actually jump into it. And vice versa. If a company stops doing very well and they're not in the top 500, then eventually they'll be rotated out. And so from a user perspective and from my perspective, I don't actually have to go in and buy the top 500 companies. All I have to do is put my money into this one fund and it takes care of all the movement for me, which is very easy and makes it really simple. So what did I do here? I just Googled top index funds. As you get more into learning the names of the big companies that are in this, Vanguard, Fidelity, and Schwab are going to be some of the biggest players. They've been in it for a really long time, and they just have a great offering. They are going to have a slightly different user interface. So pick the one that you prefer the most. If you have one that's easy to move money in and out of, if you already have Fidelity accounts or if you have Schwab checking accounts, that can make it simple. And then as you see here on the screen, the other one is going to be the fees that come along with it. So because the index funds are not managed, the fees are typically very, very small, which is really what you want when you're starting to invest. If you go all the way from you do it yourself to where there's almost no fees, to all the way to fully managed accounts where you have a specific person managing your money for you, that's where we're going to charge the most. And they could charge you upwards of 1 to 3% of your entire portfolio per year. And some of those fees they're going to take the fee out whether they make money or not make money. And so over the long run, over 20 or 30 years, that can make a really big difference into what your actual outcome really is. Okay, so we've got our index funds searched. You can really dive deep into this. There's so many options in the financial world. If you can dream of it, they will make it for you. And there's something out there that you can buy. I think the biggest thing is just to keep it very simple and understand what you're putting your money into. Don't go off of hype. Don't go off of one article that you read. Actually do some research here because it's your money and ultimately you have to take responsibility for it. But the nice part is it's set and forget. Once you take the time to do the initial investments, you can just continually buy those, put more and more money into it each month, and it'll continue to grow for you. So what are the top 3 things that we want to know of or think about when we're buying a mutual fund? Well, the portfolio, the diversification that it holds is going to be a big one. Second, what fees come along with it? And then thirdly, what's the minimum investment that's required for it? The nice part is a lot of these index funds have no minimum fee. If you get into other certain fees, they do start to break it off, and you can get into extremely high minimum investments, million plus minimum investments. But for the most part, you can find a fund that has the minimum investment that you actually have, like $3,000 or less dollars. And for these index funds, again, they're $0. Okay, well, let's just take one of these first couple that we have pulled up. You can choose whatever account you want between Vanguard, Fidelity, or Schwab. Vanguard VOO is one of the most common ones. Everybody talks about it. If you want to get outside of the S&P 500, they do offer some total U.S. stock markets, again, which is going to be even more diversified. So VTI is going to be a great total U.S. And then, of course, they have full world and global ones as well for international coverage, which is even more diversified. And so once you pick your ticker symbol, that's going to be the easiest way to look it up. And for how I start searching these individual stocks or index funds, whatever, it's going over to Yahoo Finance. They make it really, really simple. They have a nice search function at the top. You just put in the ticker symbol, and then they bring up almost all the information you need, and it's very easy to go through. So here we have VOO pulled up. You can look at the charts. Realistically, when you're doing long-term investment, none of the charts really matter. You'll want to take a look at 10 plus year returns here because we're not going to buy this and then sell it next month for a gain. That's not how the investment is going to work. The stock market is going to go up and down way too much. That's way too volatile on short terms. So if you really want, you could look at 5 years. And obviously here they have a great return because the U.S. stock market has been doing really, really well. But I would just skip this part for now. It's too much to get bogged down to, especially when you're initially looking at it. So you can go into their holdings, which again, it was what I said before, is for true diversification, we want to make sure that we're spread over all the sectors. And the one downside I think that the S&P 500 does have is that it is highly weighted for the biggest companies. And so you'll see here, NVIDIA, Apple, Microsoft, Amazon, it's a huge part of the portfolio. And so if you were to give this a critique, it's just that it's not truly diversified properly across all the sectors. But if you know that going into it, you can plan for that. And you can also just tell yourself, like, I'm okay with that. You get the pros of having more money in those big companies. And because they're so large, they're doing very well year over year. And unless you think that they're going to go down next year or in the next 5 to 10 years, maybe that would be hesitation to not buy it. But I have trust, and I think a lot of other people do, that the S&P 500 is a great index to start watching. And so on the right side here, we have the sector weightings. Tech is going to be a huge sector weighting for most mutual funds that have been performing well over the last few years, but they do spread the rest out over financial services, healthcare, energy, and that's going to be your biggest decision point when you're choosing a mutual fund. Is you can start to choose more conservative mutual funds, which would be more lean towards energy, utilities, and real estate. Or if you want to have a more fluid and higher risk, higher reward mutual funds, now you're going to be more in the tech, the um, software industries, things that are going to move faster. So companies are going to come and go at a faster rate. And so with those gains, you'll also get faster losses as well, or bigger losses. So we've got our sector weightings. We've taken a look at that. It's always good to take a look at performance. Don't get bogged down in the charts and trying to look at day-to-day stuff. That's not big at all. The biggest one that I would come over here and highlight is the 10-year. So this is an easy way to capture and see if I'm in this for the long term, what have they done in the past? It's important to tell yourself that past performance does not guarantee anything in the future. The stock market can do what it wants, and it will continue to be very volatile. But it gives you a great idea when you're comparing two mutual funds, um, because there will be some that spike really hard, but they also go down really hard. And so what you want to do is average that over a long period of time. The 10-year is a great way to do that. For most mutual funds that you're looking at, if they don't have an 8+% return over 10 or 15 years, I would just look for a different one. Um, Something in the way that they're buying funds, or the amount, their percentages and holdings is just not doing well for them. Now, again, they may have had really good short-term success, but then if those sectors went down and they didn't properly resell and renegotiate the mutual fund holdings, um, they're gonna feel the pain on those as well when they go down. Okay, so we've checked out the 10-year. It's 15%, which is really solid. Obviously, this is just based on the U.S. stock market in general. Um, so over the past few years, it's been doing really well. Okay, so we've looked at the 15-year, maybe 10-year performance. It meets the bar. It's above 8%. 15% in the U.S. Index is going to be really solid. What do we want to look at next? Well, fees is going to be a big one. These are kind of like, I don't want to say hidden because they are available, but they don't make them easy to find. And it really eats away at any type of return that you're going to have. And so you always want to check out what the fees are going to be. So when you come into here on the left side, you can go to profile. They've got a little bit of a summary here. They've got a Morningstar rating, which is another good way to look at things. But what you want to do is come down and look at here. What is the expense ratio? So VOO has a 0.03% expense ratio. Very, very small. And the great part about this is it's because it's following the index. So it's an easy way to move companies in and out. It doesn't take a whole lot of effort on the company's side. They don't have a bunch of active managers purchasing and selling stocks based on what they're reviewing the market for. It's very easy. And so because of that, they incentivize it and they charge almost no fees realistically compared to 0.72%. So that's 20x what this one is for the index. So it may seem really small. Well, it's less than 1%, but over time, if you're going to pay 20 times the amount of fees for something, there must be a huge benefit for that. And realistically, there isn't. If they're all following the same index, you should get the cheapest one you can, and you'll keep the most amount of money that way. Okay, now that we've looked at and we're starting to do some research into mutual funds and index funds, that's all nice, but it can be really daunting when you start to put your real money into that. And so there is an easy way to get into the game of financial investing without actually putting your money into it. I love this website called Investopedia. They have lots of news articles. They have help for almost any category that you need to, whether it's getting into the market or personal finance or banking options. There's some loan information here. They have the ticker symbols scrolling. And what I would point out here is the simulator option. And so you can create an account, and the cool part about it is it gives you basically a simulated stock market. You can give yourself fake money, you can purchase, you could sell, and you can watch this stuff grow over time. And so if you have some stock market or some stocks that you've been looking at and you think they would be good investments, mutual funds, index funds, come in here and just make the purchase. Um, This will allow you to say, like, on this day I purchased it and it's done this after that, whether it's gone up, gone down, all the fees are taken out. It's a great way to test your assumptions and test your judgment. And the only downside is that if you're doing this for the long run, you won't be able to test something for 10 years and then figure out whether or not it's a good idea. But if you want to test some crazy ideas, maybe some really volatile stocks, you can see what your performance would be compared to your more steady investments in an actual index fund. So give Investopedia simulator a check out, create an account, just get familiar with moving money back and forth, buying and selling things, and it can really make you comfortable. All right, so the final step here, now that you've done some research, you figured out what it's like to move money in and out, to buy and sell stocks, mutual funds through Investopedia. Now it's actually making an account. So I just pulled up Fidelity's account. Like we said at the beginning, you have Vanguard, you have Fidelity, you have Schwab, Chase will do investment accounts. Most banks will, especially the very large ones. But which account do you actually need? Over here now. So this is just going to be a personal account. You can move money from your checkings or your savings directly into it. The values that you make, if your mutual funds go up in value, that's going to be taxable gains. And so you have to be somewhat careful with that. The good thing about it is all these big companies are going to track that for you. If you sell stuff throughout the year, at the end of the year, before the next tax season, they'll send you a full readout of what you had, the actual taxable gains that you need to claim, and they make it very, very easy. The brokerage account is going to be a non-retirement account. And if you really want to put this money away for a really long time, you can look at opening up a personal retirement account or an individual retirement account. And there's going to be benefits that come along with this. If you are looking at an individual retirement account, I think the one thing to keep in mind is that it's always more beneficial to look at using your company's retirement accounts first. Make sure you're maxing out your match, your employer match. That's going to be 100% return on the money you put in because they're going to match what you did. That's going to be the best you'll ever get. And the nice part is about the 401ks, they offer basically the same benefits. You can have a Roth 401k or a traditional 401k. So if you make sure that you're doing and utilizing those resources first. The one nice thing about IRAs is that they can offer you a little bit more freedom and flexibility into where you're putting your money. Some employer funds will have limited options. They may have just large funds that you can pick from, where an IRA will pretty much give you almost all the same options that the stock market and a brokerage account would as well. So there's some trade-offs, but make sure you're maximizing that employer match first. Okay, so just a quick recap. We started from nothing. We searched what stock funds, mutual funds, index funds were. We got our ticker symbols here. All your symbols, put it into Yahoo Finance. They'll give you some basic charts. You can check what the past performance was. You can check what their holdings are. You can also check what the fees are and make sure that there's nothing astronomical there. If you want, you can go to Investopedia's website. You can actually buy some of it and simulate these purchases on your own. And then when you're actually ready for it, you can start opening up your accounts and putting real money to work for the future.